Are you trying hard to disrupt the market with innovative solutions? Do you want to make your business more agile? Which is the right path? Entrepreneurship or corporate venturing? Gain a competitive advantage by recognizing the right strategic partners. Learn the importance of corporate and startup connections, how they differ, how they complement each other, and how the best things happen when they work together. Get ready. We're taking corporate innovation to a new level.
Welcome back. So here we are in Studio 2 once again, and as you just heard, corporate innovation, looking at the world of the startup world, working together with the corporate world. This is really what these next 2 hours are all about, unfolding ideas, insights from experts that are going to share with you how we kind of navigate this through and move forward with some good advice and some great insight as well. So if I ask you, why corporate switch from entrepreneurship to corporate venturing? The next gentleman, he can actually answer that during his talk, which he's about to share with you right now. So please welcome to Maribor. Welcome to our world at Podim 2021. Partner at What a Venture from Austria, Max Ditzel. Hi Max, are you with us? I can see you. I hope I can hear you.
I can hear you, yes.
Fantastic. Great, we are connected. That's wonderful. So Max, where are you right now, by the way?
I'm located and based in Vienna, and it's quite sunny here, so pleased with weather and good vibes.
It's looking good. You're looking great there, and behind you, great weather as well. We're indoors all day, every day. Well, not every day, just over the course of the conference. So envious of what I can see through my screen, looking at you right now. So here's the drill. After your talk, if there's enough time, and if there are enough questions as well from our audience, I'll be able to share a couple of those questions with you. So remember, those that are listening right now live, if you hear something that you're curious about, you hear something that you maybe like to challenge Max on as well, or just simply like to ask Max a question on something that he's doing currently, pop that in the chat, and then hopefully we can get that out as a question towards the end. Max, listen, take it away. It's all yours for half an hour.
All right, thank you very much. So this beautiful picture actually symbolizes, for me at least, quite some things that are wrong, at least in the perception of innovation. Looking at this flashy world of new ideas, unicorns riding through the rainbows, and ninja cats jumping on board of them and trying to actually change the world. The reality, at least how I see it and how I run through it on a daily basis, is quite different. And ultimately, for me, innovation boils down to something very, very simple. There are 3 elements to innovation. It has to be new, it has to provide value, and it has to be implemented. If it's just a concept, an idea, it is not yet even close to be there to be called innovation. So all the other things, when one of these elements is not there, is missing, we are not talking about innovation yet, at least. If it's not new, it's very simply, it's old stuff. If the value is not there, it's beautiful that you have implemented something new, but why would somebody care? It's useless. And if you have not implemented yet, let's call it a dream, it might shine light to reality in the future and become innovation, but we're not there yet. So why am I talking about this? I'm working at a company called What a Venture, and for the past 8 years, we have been dedicating and focusing our time purely on innovation and making innovation happen around multiple areas. And so far, I should click, yeah. So right now we actually are headquartered in Vienna. That's where we started. We have branches in Cologne in Germany, in Bolzano in Italy, and currently we're more than 45 people actually working on multiple layers of actually making innovation happening. And how we do this is basically built around two pillars. On one side, we do empower established organizations with corporate innovation, entrepreneurship program, collaborating with startups, investing in startups. And on the other hand, it's not just the concept, the structure, the processes that we try to enable. We also try to make the things happen to build them. This is often where we see the bottlenecks of things not becoming reality and becoming true innovation and staying a concept, staying a thought or a dream. And we have been quite fortunate to be able to do this with a wide range of customers and partners across multiple sectors, and to really make things happen and drive a change there. Over the past, especially 3 years, more and more we actually became a corporate company builder from our background of being an advisory firm. And that's also how we actually started our own ventures. So we didn't just want to create the stages for others to shine the light on innovation. We actually dedicatedly picked 4 companies to make a change in their respective industries. And so far, they all are quite successful and functioning on the market in very different manners. And then this is actually the beauty of the job I can come to every day and then run through. So for us, the question of innovation and how to manage innovation, something that is quite important and dictating our daily life. So we have to ask ourselves, how do we actually manage innovation? Because ultimately, it doesn't have to be chaotic. It doesn't have to be a mess. It doesn't have to lead to failure. And in a lot of theory, we talk about this iterative processes. And quite some processes would argue, yes, the new thing is to iterate, to experiment. But to be honest, if you ask me, there's not just one process to rule the world. There's multiple ways how actually corporate innovation can happen. It's not just the methodology, may it be called lean startup, design thinking, however you want to name it. There's multiple ways how established organizations especially can drive innovation effects. And just looking at this potential landscape of corporate innovation, when it comes to internal ventures, external ventures, collaboration, forms like company building, this picture is far from complete of representing the corporate landscape, but it shines a light of how diverse things can be. And it's not just the forms that you try to actually focus on. Not all innovation is created equal. And that's quite important when choosing the right setups, the right formats, and dictating and navigating your process. And what I have found to be quite helpful is this beautiful graph, because ultimately innovation is actually, and the process of innovation management is a lot about managing uncertainty. And you can differentiate between 2 types of uncertainty. It might be the market-driven uncertainty or how to organize something. And then it might also be the technical uncertainty and execution uncertainty. And how high or low those are, we talk about different types of innovation. Might it be the basic things that it's in your market, it's technologies you know, you try to add new features, you try to add new functionalities, maybe move to a next generation. That's what people call the core enhancement. That's the things we know, that's the next generation we try to top into. And then there's multiple other forms that get more tricky and get more complicated to work with. And more or less you can say, the closer you are to your market, to your clarity, the easier to plan is it how to actually drive innovation further. And also, if you look at the top right corner, this point, radical options, radical innovation, where you have high uncertainty on the solution side, high uncertainty on the market, that doesn't equal that you talk about disruption, because disruption would happen in your field. And this is actually where things get tricky, even in existing routes, because you actually change the business model logic, you change things that are happening. And to get a bit of an understanding what I mean by these different quadrants, I brought a few examples on how this can play out. So one company, quite some people, or most people who have traveled through Germany are familiar with, is Deutsche Bahn, and they're a massive logistics company, train operator, and they even have their own IT company with 3,000 employees, and they have their own entrepreneurship program. Internal IT staff creating new teams to build new solutions that are then rolled out into the organization. That is quite widespread. And one of this example was an internal startup called Eve. And what they tried to do is basically change the way they do training within the organization. So that was very much on the core business. Yes, the trains need to function. People working in the trains need to know how to do it. You cannot always put a multi-million-dollar or euro train apart if you want to train something. And therefore, they created this augmented reality training solution that is then rolled out and then put on multiple use cases. So there we talk about core. Core can easily become something else if you put it to an external market. Another example is an energy provider that wanted to actually predict their balancing in the energy market for their trading. It started out as a cooperation between the utility company and a corporate and a startup to actually set up new processes and solutions for themselves. But they figured out it's working so well, so they positioned it externally on the market to actually try to identify if they make a business and not just an improvement within themselves. Another example, Deutsche Post DHL, also global massive logistic provider, 500,000 employees roaming around this companies trying to move things from A to B. And one thing that they had is a global entrepreneurship program where people came up with the idea is, what if we put solar mats on the trailers to actually generate electricity and kind of bypass fuel consumption, at least to a certain extent. Let's do it ourselves. The kind of truck companies, the trailer companies do not offer this solution yet. Let's do this ourselves. Let's move into a very different technical area within our company. And because it was working so well and they rolled it out in multiple countries, they thought, let's move to a different area also externally. And that's how it became actually a scout for new markets solution that changed also the business portfolio landscape of Deutsche Post DHL. And then with the rare cases where we talk about radical, one example is a company called Sperox. It was actually started by an energy company that wanted to more or less create a virtual spare part warehouse. And by doing so, they completely set up a new business model and tapped into a very, very different market for themselves. And obviously, there's quite some ups and downs and then challenges when moving into this direction. But all these things have one thing in common. They started out with people within the organization having an idea to put something further. But there's something very different when talking about innovation or people having an idea and wanting to bring it further within an organization. So entrepreneurship is vastly different from entrepreneurship. They are in existing organizations. They have their existing jobs. So they play totally different games than somebody that is rather starting from scratch on a very different landscape and environment. So ultimately, yes, when you're an entrepreneur, you want to pursue your idea. Obviously, there's uncertainty that you want to face. You do not can jump into the resources of an existing company, but you anyway push it further and want to start up some new form of business. A lot of entrepreneurship is actually about improving, protecting core values within the core of organization because they look from within. Yes, some of these ideas are moving into different areas, but entrepreneurship in principle and in its root causes has been founded within the organization and also typically founds a home within the organization. So it either funnels into an existing business unit or sometimes even creates a new business unit. Very rare cases provide something else in the field of entrepreneurship. And Maybe some of you have seen and heard the TED Talk by Bill Cross quite some time ago, and I believe it's still relevant what type of things he pointed out. So he tried to identify what are the success factors of making startups a success. So not corporate startups, but startups as themselves. And what he has looked into is there are 5 factors: the idea, how unique it is, the timing on the market, how well the team can execute, the business model, as well as the financing it provides. And when looking at corporates, the 2 factors that stand out, at least to my experience, are team and financing. Here, corporates play in a totally different world. And I'm not saying because they have more people within their organization and they have generally or potentially more money to spend, because processes are vastly different when it comes to team setups, team execution, as well as financing projects within organizations. The timing, the idea, the business model sides, these are still rather similar compared to startups as well as corporate startups. So looking at the team, a big chunk about making things a success within corporates, especially with entrepreneurship teams, is their motivation as well as incentivation. And the more far you jump away from your core business with your type of project, the more difficult it gets to actually incentivize employees and your staff, because it is things that are rather different. It's very hard to plan these type of things. It's a bet, so to speak. It's a bet for the employee. It's a bet for the company. So this is definitely something that affects quite heavily how actually teams can play a role and will play a role on the long run. And obviously, entrepreneurs and people working in company are in a lot of cases coming from a different background. They are trained in a different manner. They have experience in a different manner. I'm not saying that there are no entrepreneurial people within organizations, but it's harder to find them. And generally, even in companies like Deutsche Post DHL, where you have 500,000 employees, it's not that you have thousands and thousands of entrepreneurs sitting in this company waiting to start a company. They join Deutsche Post DHL for a purpose, and they do their job for a purpose. And a lot of them are actually happy doing so. So at the same time, the more you move towards uncertainty, the higher the need for entrepreneurial people is, apart from just people managing projects and navigating through the corporate landscape. And now coming to the next part, time and budget. So this for me is the financing side, because time is some very, very crucial resources, especially when it comes to established organization. If I now want to start my own business, take on with an idea, it's rather easy for me to spend my time if I decide to do so. Within an organization, your time is bound to your job that you had before and the task that you have had to actually spend your efforts on. And when you look at different phases of innovation, the more mature something is, the more time needs to be invested. And this is something that poses quite some challenge for a lot of organizations, is actually of freeing up resources. Because what you want to have in entrepreneurship is quite often the best talents that you have to make really these uncertain cases happen. But at the same time, it's super hard to free them up. So if you want to drive this with your team from the inside, it's quite a hard journey actually to make the people available for these journeys. And then when it comes to funding, obviously companies have different routes of how to set up something. Some companies have innovation budgets, others are purely financed by business units. So rule of thumb in core areas, quite often a proof of concept potentially supported by innovation management and innovation budget that does some co-financing. And then afterwards, the things get integrated into a business unit. If you want to scale, if you want to move further, this new home has to take on at least part of the financing and then take on the future. When it comes to new things and rather different areas, funding is a bit tricky. If it's not a core business, if the project timeline is very long, it might already pose a challenge where to actually allocate the funds from. Is it an innovation budget? Is it an innovation fund that is actually established to bridge these long-term gaps? This is something that definitely has to be evaluated. And yes, even though if you have areas like that, when a business unit, when a business area wants to move into new areas, they might finance it, but it's something that is rather rare. So the big question actually is how do you finance and how do you put to life these kind of scouting, more radical options that are not close to your core business? Because quite often the ideas behind that, the business model logic, is something that is uncertain and unclear to the company. It's not something that you can predict with a clear project path. Your templates maybe not work with the goals, KPIs that you set. And sometimes also the time frame doesn't match actually the planning cycle you have within your company. So what you need to do is take a deliberate decision. How do you want to manage this kind of risk? And if you even want to do that, you need very much different decision-making processes. You might need actually different type of people to allocate the time and understanding to make these things come to life. And this is where we then jump into this external venturing side. And there's multiple forms how to do that. Yes, you might invest into startup from a classic corporate venture capital perspective. Set up your own fund, invest in a fund, really try to make an effect with the investment that you do on the startup. And sometimes also then obviously taking these type of startup into certain venture alliances, trying to actually set partnerships that benefit both sides, sometimes even setting up very, very dedicated joint ventures that purely just work together. And to a certain extent, companies sometimes also work on a very transformational basis. They say, we acquire the companies, this is how we move ahead, this is how we move into different areas. And then there's a rather new form popping up over the past couple of years, which is dedicated company building. So a company having a topic, having an idea, and allocating funds and the team, mostly external, sometimes combined with internal, that builds something from scratch, builds something new, but not within the existing ecosystem and landscape. They move into very different areas. So the question of where you want to play and where you want to go is very much based on what are you actually trying to achieve? What type of innovations do you want to put further? And as I also said before, this landscape is far from complete. There's a bunch load, an abundance of forms how to push things further, but it's quite important to deliberate, make your own judgment call, what type of things you want to push further. And so if you want to take away a few things from what I said, there's on one side, the most important things, take your time. So it's quite important that you take your own individual decision journey and make your own judgment, what type of things fit to your organization and to your goals. And there's definitely no one process to rule them all, to rule all types of innovations, to rule all types of projects that you want to actually put further. So very much what I can encourage you to actually think about diversifying your corporate innovation landscape. Try to have different formats, different homes for different type of things that you might put further. And then ultimately be honest to yourself. So how much time, if you want to drive innovation with your employee, is very much needed from them? Can you free up their resources? So I've been working with a company for quite some years in the field of entrepreneurship. And what they do is they try to free up the time of the employees almost to 100% quite soon, at a very early stage of the projects. But this freeing up process sometimes takes a quarter or even two to find replacements, etc., before the projects even can start. So these type of things need to be catered to. You need to have also kind of process in place, because at the end, employees are just humans. They cannot do multiple things at the same time, and you cannot expect both of those things to be perfect and to actually run smoothly throughout a long period of time. And ultimately also be very, very much honest, how much resources will be needed to create success? Yes, starting might be easy, might be cheap, but think already a couple of steps ahead, what you need to have, what you need to do in order to make things actually happen ultimately. And a question that quite some companies do not try to actually look into is how many fails you want or can finance. Because let's be honest, quite some of these things, no matter if they are internal or external venturing, they will not work. And what type of ratio you want to invest and want to focus on also very much dictates the type of formats you set up, the type of projects you accept, and things you want to push further. And especially if you move away from your core areas of expertise, really ask yourself if you have the right perspective to evaluate even an idea already. So I see now a lot of companies trying to actually not just bring coaches from an external side to their teams, but also diversify juries, diversify decision-making bodies that enable different perspectives of actually making a judgment call that is not purely based on your own internal lights and the business unit perspectives and motives that might navigate you as a company. And one thing that I think is also quite important, do not copy paste in corporate innovation. So you definitely have to define and set up your own landscape according to your needs, your possibilities, and this comes for processes, this comes for methodologies. Ultimately, you have to, on one side, make your own kind of evaluation, but experience at the same time, and then build things further, and do not try to actually dictate and navigate something by one process that then should actually run through that. So with that, and I would actually close and end my little talk here, and happy to take on questions. Yeah, it was a pleasure talking to you.
Right, so we are back. Wonderful. So thank you so much, Max. That's been a very insightful sharing that you've given us today. Unfortunately, there are no questions right now. So what we're going to do, we're going to say goodbye. Thank you so much, and hopefully we'll meet sometime in the future once again. Maybe back here at this event sometime in the future. Thank you so much.
Bye.
It is time to rethink and to realign. Learn and get inspired. Prepare your questions and enjoy this insightful Podim DX panel.
Right, ladies and gentlemen, we're coming towards the end of our first day one, Podim 2021, and still on the subject, on the topic of corporate innovation. So, is corporate venturing corporate innovation 4.0? That's a question I want you to think about, and it's a question perhaps you'll be able to give an answer straight away, or maybe for like most of us, have to think a little bit more about that to get to the answer that you want. What's going to happen now is we're going to jump into a panel discussion, a productive, effective a discussion about the answer to that question. And so right now I'm going to introduce to you a lady who's going to be the moderator, who's going to navigate her way through this discussion, helping us all make sense of what's been said. So please welcome the CEO of Explorer International from the USA, Michelle Messina.
Good day. It's a pleasure to be here.
Michelle, wonderful. Can I ask, where are you right now in the US? Which city? Where are you?
I'm actually in Silicon Valley, so just about a half an hour south of San Francisco, California.
Fantastic. Right now, I'm looking at my phone at the time. It's 6:30 in the evening here. What is it there? What time are we right there?
9:30 in the morning.
Oh, so we've had our day. We've had everything go past us. You've got it in front of you, literally. Right. What I'm going to do right now, this is where I take a back seat. I hand the baton over to you, Michelle, and I'll let you take over and really see what unfolds for our listeners right now. Over to you, Michelle.
Thank you so much. My name is Michelle Messina, and I'm based in Silicon Valley. Very pleased to be the moderator for this panel. Is Corporate Venturing, Corporate Innovation 4.0. And we have four excellent speakers today. We have Shubber Ali, who is based in the USA in Maryland, and he's VP and Global Team Lead for a company called Elastic. So please welcome Shubber. We have Monica Keck, who's CEO of Blue Hera, and she's based in Switzerland. So Monica, thank you very much for joining us today. We have Max Ditzel, who is in Austria and is with What a Venture, and he just got done with a great discussion around corporate innovation. So welcome again, Max. And I'd also like to introduce Dr. Robert Günther, who's with Henkel. He's head of corporate venture capital in Germany. So thank you all for joining us today. And we appreciate the opportunity to have your insights. I want to start off with a couple of definitions around what is innovation. The creation, development, and implementation of new product, process, or service with the goal of improving efficiency, effectiveness, and competitive advantage. Do we agree or disagree with that definition first off, before we jump into all the issues around corporate venturing and corporate innovation?
So I would say I agree. As I said in my talk before, it pretty much reflects the few things I had in mind. It has to be new. It has to provide value. So we talk about improving efficiency, effectiveness, etc. And also it has to be implemented. So not just creating something, it has to be out there. And I fully agree with the definition.
Any other comments from our other panelists, or should we jump into the definition on corporate venturing?
I think we just jump right into it.
Good. Corporate venturing, directly investing corporate funds into external startup companies via joint ventures and equity stakes. Any issues or comments with that particular definition, Shubber?
Into external equity stakes? No, that works.
Okay, great. All right, so let's talk a little bit about why companies get involved in corporate venture capital. What are their end goals? And do they do an effective job of clearly communicating these goals in advance?
So hopefully, and just naming our, let's say, approach that we have. So Henkel has an open innovation approach of actually approaching innovation in a, let's say, generalistic way. Part of it is, as it was also mentioned in the presentation beforehand, first of all, we have the corporate venture capital, we have the kind of collaborations, we also have the incubation, and that's a kind of the setup we also follow at Henkel. And from my perspective, that's the only way to go. And it's an integral part. You cannot just choose one part of it. And yeah, CVC, corporate venture capital, is part of it.
And what are some of the risks with respect to not clarifying their goals in advance? This mismatch of expectation on corporate venture. I think Shubber was the one who said the other day that between 70 and 90% of acquisitions fail, as a Harvard Business Review statistic, I believe. So what about corporate venture capital is not working?
Well, I'll just start to build off of that. And I actually was echoing. I think Monica was the one who actually first brought it up. But the statistic is correct, and the issue is usually because they don't clearly define what their actual strategy is as to what they're trying to get out of it. And so then it's kind of like why we defined innovation at the beginning of this conversation is if people don't agree on the definition of what you're trying to do, then it's really not surprising when there's a divergence of expectations around the outcome. And so if you don't know why you're doing something, or you think you're all in agreement, but it turns out you're actually looking for different things, then there's gonna be a lot of disagreement later on when you actually get to the results that come out of it.
Let me add,
do you have any insight?
Yeah, let me add that I think planning is a crucial thing. So our experience is that usually these transactions just happen from the internal point of view, because there are some scouts working on something in silence because not to disturb the mature part of the company. But when it gets revealed, it causes a huge confusion inside, because there is something new coming in or popping up, which should be handled. And sometimes the cultural issues come to the surface at the very last stage, which are not so easy to handle that phase. So my opinion is that what is really the problem and what is behind the failure of this more than 70% of all transactions is cultural transformational issue, mismatch, not properly managed expectations, and not so well planned implementation.
And actually getting the buy-in internally, I think, building on what you just said, I think it's very important that it's not only a top-down decision to do an acquisition, but actually get the buy-in from all sides internally, resource-wise, and also then to bring the entire thing forward. So I think it's a pre-alignment. It's a job that needs to be done beforehand, because otherwise, once the acquisition is done, the focus needs to be on bringing it forward, and not starting on potentially integrating it and making sure that everyone is on board already. Yeah.
Can I add something here, just to be very provocative and a little bit of highlighting the negative side? Have you ever tried to call on board people who might feel themselves as a redundancy as an end result of an acquisition? Because once you are about to acquire something, to integrate something, I think the first thing which pops up in the mind of people inside the organization, the acquirer, is like, okay, am I working against myself?
So of course, I think that's always the case.
Not always,
but usually, if you do an integration, if you acquire a company, of course, synergies play a significant part, and I think it goes without saying. But again, it's about how you communicate. The communication usually should be in the way that we are interested in people and not in positions. Therefore, if there might be a kind of a position that is doubled and needs to be rationalized, if you're a great person, we will find another job for you. But maybe it's interesting because you mentioned it, because especially when it comes to CVC integration of startups, I think one thing which we also usually see is the not invented here syndrome, because that's also something, because you need to have the buy-in from your R&D people, from your actually people who are then selling the product. And if you then tell them, you 500 R&D guys, you are not able to get to the point where the startup is with 2 people after 2 years, then this is again about how you communicate, and I think that's a very important point. That if it comes to interesting transaction and so on, you really need to have the buy-in, and it goes to the point which you raised when it comes to rationalization and so on, but it also comes to innovation and also integration.
Yeah, I'll actually double down on the provocative side, because I think that, and we have to make sure we're not confusing traditional M&A with corporate venturing, because traditionally M&A is a result of a company that's run out of good ways to grow organically, and so they come to the point where it's like, I'll go buy somebody, because that's what the C-suite is rewarded on: top line growth, potentially bottom line growth, and the playbook is well understood. I buy a company, pharma companies have done this for decades, right? Which was kind of crazy, because 20 years ago they were all looking at the patent cliff, and so instead of innovating new drugs, which is the way you get out of a patent cliff, they just started buying each other, which just made bigger companies with the same patent cliff. But M&A is a playbook that's well understood, because you buy a company and then you start cutting jobs. because then you're actually able to get more, economies of scale and redundancies, which generates more earnings and blah, blah, blah. That's pretty straightforward. Corporate venturing fundamentally is supposed to be about, let me go and identify new things that might be DNA I want to inject into this company, whether it's new markets I'm going after with new capabilities, new technology. Sometimes it's just acquire, but it's really about, I'm trying to break into something new versus I'm going to go buy a company. And I want to make sure that we're differentiating between the two, because if corporate venturing is failing because, we're not integrating the culture well and we're making people redundant, are you really actually buying them for the right reason? Because if the theory is that they were actually this growth engine, then why would you be cutting them as soon as you brought them in?
So maybe it's also important to be more specific on what corporate venture capital is. So corporate venture capital is not acquiring companies, and it's primarily it's about acquiring minority stakes. It's the foot in the door. It's about maybe some skin in the game when it comes to collaborations, and it's in the end it's not kind of pushing the startup into a direction, but it's actually a win-win situation in which the corporate and the startup can collaborate, can learn from each other, and have a mutual way forward. But what it isn't is, like you explained, it's not M&A. It's not that you actually put the corporate structures, the corporate everything on a startup, because that's totally different, because that is when it gets very complicated, and when it's also a totally different approach. Because M&A, if it is of a startup or an old economy company, it's always the same, because it's about the synergies, rationalization, and so on. But CVC, corporate venture capital, is minority investment in innovative new companies, which might turn out to be an M&A in the future. But in the beginning, it's about minority stake. It's about the founders being in the driver's seat and bringing it to the next level.
So let me ask a question here. Do we think that there's perhaps too much corporate venture capital money available today?
There might be. Because it seems to be that in some industries you have quite an abundance of CVCs actually, and more companies are setting up CVCs, are thinking about setting up CVCs. And what I believe is more important and ultimately quite important is that before doing so, they have learned the fundamentals of how to collaborate with startups. If they haven't done this right, and if they don't know how to create this win-win situation that you have been referring to, Robert, because this is what it's ultimately be about, not just leveraging your financial interest and investments, because then ultimately you will always have a conflict of interest between the corporate strategy and the CVC strategy if you cannot leverage these sides together. And this, I believe, is the fundamentals that need to be there before jumping into the CVC. And then obviously the balance is not controlling a startup to death, is a quite big challenge to face. And what I've seen so far, most good teams, or all good teams, they find money. There's an abundance of investments and financing out there. There's actually very few or too few good companies in quite some cases. And what I've seen, especially CVCs missing out on in quite some rounds is the speed. So quite often, also I've just seen quite recently a case where a company was raising funds and they were open for CVCs, and they went through multiple CVCs as well. And this one company came with, a term sheet of 55 pages. And then they sort of said, I have one now with 2 pages from your competitor. Why would I spend the time with you? I'm closing around in 2 weeks. And they said, yeah, we have to get back to you in 8 weeks because our lawyers need to check things. They are not fit to play the game and to make their money actually work and then move ahead. So I'm not sure if it's the question of too much. It's more the question if it's the right one that can make smart investments, that can run smoothly and foster collaborations afterwards.
I'll say I think there's way too much money. The market is like flush with liquidity in every sector, which you can see if you look at everything from traditional stock market to even cryptocurrencies and the rest. There's a ton of money out there, and governments right now are printing it like it's going out of style. So there's gonna be a lot more money out there. So is there money in the corporate world as well? Yeah, clearly look at the share buybacks, look at the the funds that are out there in lots of places. The issue is, do they know why they're investing in this, right? And this is, I think, the point that was just made is exactly right as well, is they move at a very different speed than startups do. And, we talked about this in the last call, was, startups are a bit like mayflies. They have a life expectancy of about 24 hours. And traditional corporates tend to be more like, trees. And they work in, years and decades, and in some cases centuries. And so you can have a meeting and it's 8 weeks till the next meeting. From the corporate's point of view, that's actually moving pretty fast. For the startup, they're like, look, I can't sit around for 8 weeks because we live with the small amount of money we have. The problem is that a lot of companies that I've seen are setting up CVC arms in the same way that over the last 10 years, they've been setting up innovation arms. They're doing it because it's the thing to do, not because they actually know why they're doing it, what the outcome is they want. It has the right management. It has the strategy behind it that's tied to the business units and everything else they want to achieve. There's none of that there. And therefore, when it comes time to make decisions, they go back into traditional corporate paralysis mode, which is, well, let me run it by legal. Let me get 50 people to sign off on this thing, et cetera, et cetera. When the rule should be, if you can't say yes, you're not allowed to say no. Just get out of the process.
Let me raise one thing here from the other side. On the receiver side, which I feel is a bit detrimental because of the lots of funds available. And as Max said, some of them are very easily available with not so complicated terms and relatively quickly be on the bank accounts for spending. What we saw is a kind of corporate hedonism or company hedonism, which takes several forms in the receiver side, which means that they got comfortable very, very quickly with the money and the lots of money, more money than it was very necessary to go on with the activities, and sometimes overspending to unnecessary, unproductive things, not to mention like my visit to the garage in one of the corporates in Winterthur, seeing like 8 Ferraris and they had only 10 employees so far. So I was thinking about that it was the right area of spending to start with in a development phase. And unfortunately, from the investor side, it can also entail in the lack of efficiency efforts, because they are simply not forced to do that as long as they have all the prerequisites of their existence and survival. So I would say, again, which is looking good on paper, you have to find the right amount, the right purpose, as Max said, or Shaber, you said, the right purpose, and also the right structure. Because one interesting thing, mostly we think about equity, but if you go to the banking side, who are suffering now from having nothing in their loan book, they are quite flexible and they have much better terms in certain areas than the equity investors, so to say. So as a summary, 2 things. Too much fund could be detrimental because it makes laziness to formulate, and it can be amplified by the improper structure of funds available, meaning financing, let's say, OPEX-related instruments from equity, which might not be the real purpose of those kind of investments, I would say.
I just want to build on the kind of money availability in the market and also CVCs. And from my perspective, there are some prerequisites of successful CVC. It's first of all playing to the market rules. Market rules are, you are not going to get right of first refusals. You are not going to get terms which a competitive VC would also not get and would not put into term sheets. So first of all, the corporate needs to understand the rules of the game. Second of all, also what Max said is, what are the value adds that a corporate, a CVC can bring? So do you really know what you can deliver and what is expected by the startups, and how do you ensure it? Because you usually maybe have one or two options to actually show what you can do, but then your name is burned in the market, because if you're not delivering on what you promise, startups are talking to each other, and your name is burned. So that's the second very important point. The third point is, when it comes to money, of course, the startup also needs to do a due diligence on the investor side. So is it just the money I want? So maybe then the corporate in an early phase will give higher valuation, or will give you more money. But you really need to understand what is in the long term. So maybe you're getting more money at the moment, but also the kind of hurdle is going to be much higher to achieve the next level. And what is also very important for corporates, and I have to also say it to Henkel, the level of motivation to actually collaborate, and also to invest time and money is getting less and less in case you are not performing. Last point, corporates are huge. It doesn't move the needle if they invest 10, 15 or 20 million, and it moves the needle for a VC. Therefore, we need to be careful that we are not running into a trap where it says we are overspending or overpaying and destroying the market.
All right, let's switch gears slightly. A long time ago, Citrix used to have an innovation lab in Silicon Valley that was focused on cultivating and working with startups that were directly tied to Citrix corporate goals and objectives and their strategies. They shut down that lab a couple years ago. Telefonica out of Spain started the Wyra initiative 10 years ago, which was basically startup innovation factories, more or less, throughout Latin America. And that's still going strong, but those were technologies not necessarily core to Wyra's business. Can corporations really undertake initiatives that are not directly tied to their corporate goals and objectives? And how do they manage that whole process with respect to communicating to their shareholders that we are stepping out of sort of our core to look at new business opportunities? How do they manage that process, and what are some of the risks associated with that?
So I'll take that first, because it's kind of, I think it's one of the reasons why corporations don't innovate is that, sure, companies can do it. Most of them don't. They don't do it because to manage your investors, if you're an established public company, is very hard to do, because they have expectations that are usually around what are your quarterly earnings, what are your annual earnings going to be. And as we talked about before, when CFOs take over from CEOs as the new CEO, they become complete optimization machines. They stop actually focusing on investing in innovation, whatever else. But all you have to do is look at Amazon. Amazon's a perfect example of a company that is in like 16 different industries now, none of which were the core industry that it started with, right? And why do they do that? Because Jeff Bezos built a model that says we start by looking at what our customers, even if they're not today's customers, what the customers need. Do we have what they need? If not, let's go buy it, build it, acquire it, whatever, and let's go enter that market. So they've gone into, obviously they started with cloud services to help themselves, but that's a huge part of their business. They've gone into groceries with not just Whole Foods, but Amazon Fresh. They've gone into pharmaceutical distribution. They do books. There's a great chart from a website I used in my presentation earlier today that shows all the different industries they're competing with now, because to them, there is no boundary. There's no box around them that says thou shalt not go into that. If there's an opportunity and a market need, they'll find a way to go after it. And it may start with investing in something and then ultimately acquiring it, like PillPack, for instance, in the pharmaceutical side. But it's more because traditional companies they're not willing to take that risk or take that position because they lack the leadership. They have managers, they don't have leaders.
Well, Amazon certainly is the exception to the rule.
But they don't have to be.
Exactly. But they are at this point in time.
Yeah.
Any other comments around, doing corporate innovation initiatives not directly tied to strategic objectives?
The question is actually what is your value add in areas beyond your core, and I think that's the big issue with established corporates, because they know their business inside out. They know, for example, Henkel knows consumer goods. They know how to sell washing powder and beauty care products. But when it comes to real innovation, to be honest, it's something everyone talks about, but in the end, it's not walking the talk in the end. And I also have to be fair with that, because we also do those kind of innovation labs where we say, okay, we want to have the moonshots and so on. But to be honest, corporates, based on their incentive, on their structure, they are not going to actually participate in the moonshots.
A small thing to add here. So I think at the end of the day, everything is about shareholder value, right? Because what else? And once, as Shabert said, you see some side areas where you think you can add some to the existing shareholder value, why not to go there? But once you decide that you're ready to take risk, a higher risk, let's say, for a higher benefit, then what if we just simply change the label and say that, okay, from now on, this is a strategic objective to do so, right? So I think that's a dynamic thing. It's not like a piece of paper that we file that this is the strategic objective once and for all, but it could be to find edges where we can continue and innovate further by buying into somebody else's innovation, let's say. Why do we think about so statically about strategic things?
Is that because their markets are so large and they're protecting their markets and their customer bases and their infrastructure and their supply chains? Could that be because it's such a massive unit that's been built over time?
It's because they don't have to.
I'm sorry.
Sorry. I think one comment. I think they don't have to. In case they have to, it's like in the automotive industry. If you see the electric vehicles coming in, then they need to be innovative and they need to think out of the box. But established companies, to be honest, if they are in a big enough market, and it's much easier for them to sell the products maybe globally and maybe attract another market than just being totally out of the box thinking.
I'm going to echo what Robert said, because there's two things on that. One is that when companies talk about growing, a decade ago when I was asked to build the Global Innovation Program at Accenture, I was asked by the head of one of our business units, and they had already looked at all the other ways they were going to get growth. And there was still a gap between that and what they needed. And so hence we needed innovation to fill the gap. But you have other ways to get growth as a business, right? You can do geographic expansion. You can do product line extension, which you might call incremental innovation now, but before it was just, product extension. There's lots of things you can do before you have to then create the net new, which is the innovation side. So the first piece is to recognize what are we actually trying to get from it. But then the second part is that big companies don't have to do it, because if, again, I go back to this thing about leadership and management, is that in big corporations, there's a joke about the factory of the future that in the future, these super high-tech factories are going to have one employee and a dog. And the employee is there to feed the dog. And the dog is there to make sure the employee doesn't touch anything, because the factory runs itself, right? Management, in many cases, in a lot of these big corporations, and I'm only slightly oversimplifying here, is basically that employee in the factory. Their job is to make sure the stock price doesn't go down and they don't come off the rails while they're there, but their tenure is not that long. And what they're going to do is get their options as valuable as possible, and then they're going to move on. And all you have to do is look at corporations like GE to see what happens over 20 years when you do that, right? Everybody looks down and goes, oh my God, they lost $500 billion in value. Well, you could have seen that coming. But the point is They were delivering what the street expected all the way down as they slid down as well. And as long as they do that, the management, which is not leadership, the management is perfectly fine, which means they have no interest in betting the farm on new innovations and trying new things, because that's not actually what they're being incented to do.
So they're not incentivizing proper behavior, perhaps.
Well, their board of directors, their shareholders are not asking them to, right? Of course, because the shareholders don't care. If the stock price goes down, they sell the shares, they move to something else. That's the problem with having your shareholders be your only determinant of what you do. They don't care if the carcass dies eventually. They'll just move to other investments. And that's the problem with them, the management just caring what the shareholders think versus the company. There was a great conversation with Simon Sinek yesterday that I heard, where he talked about this and said, if a company is making its earnings and it's laying people off, it's missing its actual purpose. Because what it's saying is, we can make our earnings, but we're going to lay people off. Well, but the long-term success of the company is what matters, and the employees, not rewarding the shareholders with a bigger dividend. Because you can do that, and then they'll leave when you stop paying the dividend. And what are you left with? The shell of a company, because you've destroyed the culture.
Throughout this panel, quite often we use the word strategy. It has to be fit to strategy. Strategy has to be established. It has to be clearly communicated. By that, we actually imply that there's always a strategy. And I argue quite some companies, based on shareholder perspectives and then just the sheer size, they are just so busy with operating that there's no time for strategy. If you would move to most companies and ask individual people within this company, it doesn't matter if it's two different people from the board or more down the line, they would give you different answers on what the strategy is. And it doesn't have to be a 500,000 people company. It can also be a small company like us with 45 people. People will have different perspectives on that. And this is why I believe, with all the things that we want to do in order to move to different fields of innovation, the consistency within these things is quite important. And then this comes from either strengths of people involved in that. If you are in a corporate venture capital fund, you're not just deciding for smart ventures and decisions on investments. You also have to navigate through the corporate. So it's a quite tough job to do, actually, to do these type of things and run through this organization. And this needs deliberate consistency in what you want to do, what you don't want to do, and then also killing shots along the way. And then you cannot always ask and wait for this strategy to happen. It might never will, and might ever be evolving or changing.
So I hear lack of strategy.
I'm sorry.
I hear lack of strategy, misalignment, miscommunication. Over to you, Monica.
And the lack of leadership. Probably.
And lack of leadership.
Just to add something.
Well, that's the most important one, because from that distills everything, right? The lack of a why for your organization. All of that distills from the lack of, and this is again a pet peeve is, I had posted this on LinkedIn recently. It was interesting to see the responses. It's like when people post their own articles and call it thought leadership. There's just a certain level of narcissism that goes with that, where you say, here's my latest piece of thinking, and it's leadership, right? It's thoughts. And then if other people like it and it gets a lot of following and support, then yeah, it's leadership. Otherwise, it's kind of like somebody had said recently, you're just out taking a walk. You're not leading.
I think it's getting like football, that everybody has an opinion on.
Yep.
Mostly those who have never played and never watched, they have the most, I guess, and they are ready to post it because the context doesn't disturb them and doesn't scare them away for making an opinion. And you know what, just one sentence here, what I also feel very detrimental, that we are getting a little bit fled by very average or very not so valuable opinions circulating, and unfortunately receiving validation from non-professionals as well, giving the impression, let's say, to students or youngsters at the companies that this is the thing, because many people read it, many people like it, many people comment on it. So it might give them a false picture of reality or professional areas, so to say. And leadership is a very good example. So I stopped following this hashtag, for example, because it was so disturbing for someone after 25 years. So I said, okay, no, I cannot live with this noise. I'm sorry. So it's better to shy away and try to isolate myself from these discussions, unfortunately.
Okay, so let's take the second half of this panel discussion and focus on best practices from corporate innovation, from corporate venture capital. What are some of the things that our audience, which is primarily corporations, can learn from us about what they should and should not do? And Shabar, I'll jump in with you first to get your take on it. Where do you think we need to start? We've got the communication, the misalignment, the management, and the lack of leadership. There's a lot of different factors happening there. So what's your take on it? How can we provide insights to corporations looking to jump into this or refine what they already have?
Yeah, no. So I think they should be doing it. What I was calling out earlier is that it seems like too much of it is the trappings of it without the strategy behind it, which leads to lack of the outcomes you want. So one of the first things when I talked to my corporate clients before about, whether it's corporate innovation or corporate venture capital, was to say, what is your objective? What are you trying to do? What problem are you trying to solve? How is this going to fit in with your overall strategy? Because innovation strategy follows from corporate strategy, just like venturing strategy follow from the corporate strategy, but then it should also inform back. So it's very iterative, because when you're out there looking at things and learning things, you might discover something that could be very disruptive to your business, which then needs to feed back in strategy so they're not unaware of it. But you need to have really clear marching orders. It's a bit like when executives would say our company is going to be 20% more innovative, the first question I would ask is, have you changed the metrics of all the direct lieutenants of the CEO? Because if you haven't, then they're not going to be 20% innovative. They're going to do exactly what they did last year, because that's what they are measured on. And people work toward the metrics that they're designed on. That's how business works. So all of that has to be laid out clearly up front. There's an old saying from the Midwest where we used to live, measure twice, cut once. Mm-hmm. And if you don't have that really clearly defined, you're going to make a lot of mistakes. But nobody wants to do that. They want to do the fun part, which is I'm going to go run a VC fund, or I'm going to go and have an innovation center in Silicon Valley, which so many companies have opened to no result. I'd say wait on that. Just wait, figure out why you're really doing this, what you're trying to do, and then structure accordingly to, like, many of the principles that Max talked about in his presentation, I think are absolutely valid once you know why you're doing this.
So Max, I will jump over to you. Not everybody who's watching this panel will have seen your presentation, but give us sort of top line best practices that you might want to share.
I mean, especially when it comes to corporate venturing or establishing collaboration with startups, I believe that's a muscle an organization needs to train. And what I've seen quite successful with few companies and in multiple sectors is that they first set out to actually find a process, find some best practice, how to collaborate with startups to prove to the inside that actually there's value in collaboration. We actually set up the process, how to set up an NDA, how to work together on these type of terms of very, very early stages of getting these partnerships going, rather than taking the big step of investing quite early. And once you have found that, once you have nurtured a culture and this muscle of collaboration, this is then when you can accelerate it. When you can prove to the market, to the startups that you actually walk the talk, like Robert said, and you can also apply now additional terms, can co-invest aside from actually accelerating a business and moving it to new heights and new values. So this is what I would, especially for companies starting out in this area, would advise to try to find some format of training your muscle. And it doesn't have to be an innovation center somewhere with a high price tag on the square foot of your rent. It can be a little program that you do. It can be a little example that you do of actually taking a challenge of a business unit and trying to solve it with an external partner, and then making them unite and making them work together, and then build on that with your processes, with your establishment, etc. And then what will happen quite naturally is the more you do these type of things, people will see we miss out if we do not invest. because you might accelerate the startup with the first pilot client customer agreement to new heights, and somebody else invested and also partake in this type of upside. And then through that, then you actually create more the urgency and need and then clarity why these things need to go further. And this, what I would also say is to always think of collaboration and investment in combined terms. It might be different units, it might be different people within the organization, but you need both as a company, as a corporate, to be successful in it.
I want to come back to what Max just said, because it was also ties to the point I made earlier about knowing why you're doing what you're doing and really thinking it out. Because is the purpose of the CVC to get a return on investment, meaning I'm investing because I want to get in early because I want the pop of this company that goes IPO or something, which is a silly thing for corporations to be doing with their money, by the way, because that's not actually the best use of your capital. If it's just going out and making investments versus doing it because it's a strategic thing that fits your portfolio, it fits what you're trying to grow. It's a technology you want to bring to market that maybe is early stage, but you wanted to. Accenture was doing this. We were investing in companies, or they were investing in companies, mainly to accelerate the capabilities of those companies because their clients needed those capabilities. And so by bringing it up faster, then we could sell more actual, business to the clients because now this technology existed, right? Now, if there was a return that was made on it, that was a bonus. That wasn't the primary purpose. And so it's really important to understand, why are you doing the corporate venture capital? What are you trying to actually achieve out of it?
Robert, do you want to share some of your best practices on this? Our audience being primarily corporations, I'd love to hear your input.
Sure. So just one remark on what was just said. So from my perspective, yes, there needs to be a strategic value in what you do, but there always needs to be also a financial return, because corporates think in financial return. Let's say strategic return is always harder to understand, harder to get, and harder to convince. Therefore, there is no long-term CVC with a, let's say, validated return. So just commenting on what was just said. On the key takeaways. So first of all, what is very important is that venture capital or corporate venture capital is a marathon and not a sprint. So bad news will come first. So if you have a portfolio, of course, you need to get the buy-in from your top management, and they need to buy into this, not as a kind of nice to have thing to announce and maybe to also reconsider it in 2 years, because you need to have a 10-year plus horizon to do investments. First of all, to get a portfolio of a decent size, to also be able to deliver on the value, and also, to be an attractive case strategically and also financially. The second point is keep your startups independent. So don't try to do M&A with CVC. That's totally different. Learn and support, but on a push versus or on a pull versus push basis. So don't push them, but ask them if they need something. And then third point is differentiate beyond money. That's, I think, a very important point, because also an investor needs to have a USP. And as a CVC, what is your USP? What can you deliver? And which is paired to the last point I want to mention is delivering on the promises. So first of all, you need to make sure that you have a USP, that you have also the resources, the buy-in internally to deliver on those, and then make sure that you deliver on those. And in the end, why will you be getting good deals? It's because your portfolio companies will talk good about you because you brought them to the next level.
Great insights. Thank you for that. Monica, your 2 cents on best practices.
I'm a little bit less humble on this topic, because I think there is nothing bad with just going for the financials when you think about venturing. why not to have the upside and don't care too much about the long-term strategic partnership? I think nothing is wrong with that. And to go further, I guess if you just put your toe into the water, it can come as a result that you will jump into the water at the end of the day. So you start with small stakes and see what comes out of it, but you can still decide to turn the whole thing into an M&A and say that, okay, I'll buy it as it is, integrate the personnel, if they are key personnel attached to the product or the service according to the profile, and then continue from there. So I would say I wouldn't make such a big distinction or a sharp distinction between the two things. I think when you start, you might not know where to end up. To tell you one example, one of our biggest clients nowadays decided upon our advice to make an inorganic growth completely by buying into those areas where he didn't have enough patience to go from scratch and develop or establish from scratch, but we were delivering him the potential target to take a look at, who had the capabilities he was eager to have, and start in the inorganic way to buying them to grow with his own businesses. And the huge dilemma, of course, as we referred to, appeared that is it possible to keep only the capabilities and get rid of the original funders after a while at the end of the day because they are no longer interested in continuing, or to find some kind of a cooperative approach and keep them inside once you have acquired them fully and make them motivated and even more inspired to continue within. So I guess these borderlines are not so sharp. At least I wouldn't insist to make such sharp distinctions between things.
I think it really much. Go ahead.
Yeah, I would actually try to distinguish sharply here because what you explained now as an example, that is a classic M&A case. And then it is something different than CVC and corporate venture capital, which is a risk setup fund that tries to generate some returns. And yes, in principle, because it is tied to the corporate, it also has to fit somehow to what the corporate is doing. And it might be diversifying, it might be de-risking in certain areas, but there needs to be something. And the process is different from classic M&A and acquisitions.
Yeah, and I would say that I have a very hard time believing that corporations should be taking their money and setting up essentially small wealth management or investment banking functions that are just looking for ROIs by betting on companies, because that's not what their business is. Now, if they think that's what their business is, then I'm pretty sure their investors would question, like, if that was truly their strategy, was go invest in any startup that you think is interesting and might have a big market potential, even if it doesn't fit your business at all. So for instance, here's your opportunity to invest in Facebook. Go back 15 years and say, to Ford, you want to invest in Facebook. Well, why would they invest in Facebook? You can make a very tenuous argument, social, therefore cars buying, blah, blah, blah. But reality is, if the argument is buy into this company because someday it's going to be worth, $100 billion, that's not the job of most corporations to be making those kinds of bets. If it's aligned to things they need. Now, whether or not you keep the employees is a different question. And Monica, you're right, because it depends on if it's a product or a service or a knowledge-based company. If you're hiring knowledge workers and then you fire them, what are you keeping behind, right? And I've seen many examples where that happened, where a company bought the talent, got rid of the talent, and found they really had nothing left but logos, right? And that's our company, but it's not, because they're all gone. But if you're buying a robotic surgery device, you can get rid of the people if all you wanted was that device and you want to add it to your product portfolio.
Still, I have to tell them, I'm sorry, there is some tendency. So I have more than one client. So I think there are some considerations going on around such things like what you mentioned as a small wealth management company, simply because they are just looking for their ways of growth, where to go, which areas to appear. These are not complete novelties, but as a snapshot, you wouldn't say that this is a strategic fit immediately. They have some visions and they try to tip their toes here and there, but they haven't decided yet, but they see the potential. And what is in their mind is that, okay, we either earn a hell lot of money because of the business potential and then sell with an upside, or we will integrate and we go further down that road. So I guess when we talk about big, mature, focused corporate, you are completely right. I agree with you, Shaber. But when we go down a little bit in size, like this mid-size or smaller size, who are still big enough to be financially strong, I think you see much more interesting moves around their traditional markets where they started from. So I would be much more flexible or much more, how do you say, humble making such statements, because you never know what is in their vision. And sometimes I wouldn't say that it's a bad one necessarily.
Well, but so Monica, I'm not disagreeing with that. What I'm saying is, if you don't have a vision or a strategy that says we should be investing in these areas, then literally it's no different than buying lottery tickets. You're saying, these are my bets, I'm placing them. Trust me, as a shareholder, I'd say, give me a dividend, let me make my own investment decisions.
The truth is somewhere in between.
It's perfectly valid if you want to say you want to diversify. So I see this also often with, as you mentioned, smaller companies, but yet big players. They sometimes have a couple of hundred millions in revenue, sometimes a couple of billions, often somehow still in ownership structures that are not public. And then what you see, especially with new generations, they think of, why not diversifying our portfolio? So they deliberately setting up investment structures to branch out into different areas because they see a decline in their industry and they want to actually protect their future. But it is something that is tied to strategy, and it is something that is deliberate. And also they have to very carefully calculate how many investments or how many failures they can finance before actually being moved out of the market.
That's a good point. Yes.
So in the last 5 or so minutes that we have left in this panel, let's just talk about alternatives to corporate venturing, and if corporations should look at doing multiple initiatives all at the same time to see which one pops, a little bit along the strategy of venture capitalists where they invest in lots of companies. So can you talk a little bit about, partnerships with accelerators, company building outside the existing structure of the corporation, scouting, third-party funds, just a little bit from the last couple minutes or so related to alternatives to corporate venturing or adjuncts to corporate venturing?
So I would argue every bigger company or every established company should think about diversifying the formats and the type of innovation and initiatives they run. As also mentioned in my talk, there's a very, very wide array of options that you have available. You mentioned just a few of them. What you have to be careful is how many of these things that are newly established in the company your organization can digest. There's just so many flashy news of new projects and programs you start in your company that people want to hear and people can hear. And ultimately, if you want to think of deliberately and strategically building up your innovation engine in the company, think of diversifying different type of activities for different type of goals, but think of also doing it maybe one at the time, two at the time, working in different areas of the organization rather than actually overloading everybody. And then each business unit is just annoyed by those innovation guys taking away their time and not contributing to their bottom line and top goals that they have throughout the year.
It's also about clearly setting borders. Because if you have corporate innovation unit, then you have corporate company building unit and so on. And everyone is jumping on the same topics and also taking away the attention from the same employees and also coming to the market with the same kind of approach. I think it's very important that you have a clear structure and a clear strategy on how you actually tackle the different topics, and also how you position them in the market. So you cannot tackle all of them, and you need to actually align those. Because what also we have done in the past is maybe overdoing it in terms of what kind of initiatives we bring forward. In the end, you need to have a clear vision on what do you want to do in which stages and what you deliver, what is your USP, why should companies come to you, why are you doing it? And I think that's very important to always keep in mind. I think, yes, more is in most of the cases better than less, but you can also overdo it, and you can also distract in case you don't have a clear focus.
So fine line balance. Comments from Monica, and then we'll wrap up with Shabar.
Only one very short one, that careful planning in advance. This is the key thing to take away. So you can do many things, but you have to properly plan everything in advance to be successful at the end. It has never gone through the plan A in my life in 25 years, I have to tell. So you have to prepare for B and C as well. And you have a fairly good chance to go with the C finally, and that should also fly.
Yeah, and I know we say planning a lot, but that's, again, I go back to, it's really simple. If you don't know what you're trying to achieve, then it doesn't really matter what you structure it for. So you have to be really clear about what your ambitions are. And then every now and then you might get lucky, right? You know, Yahoo had a stake in Alibaba, if I remember correctly, and that was worth more than everything else they did. The argument is, why did they fail, right? If, you know, but the shareholders made out. The key is to say, why are we doing this? What is the point of the venturing part of this versus the innovation part versus the M&A part? Because they all have a role to play, but it has to be defined a lot more clearly than it is generally today.
Well, Shabar, thank you so much for that. Monica, I appreciate your insights and feedback today. Robert and Max, very insightful comments and very helpful. And thank you, all of you, for joining today to talk about this interesting topic. We'll see how things evolve and change during 2021. And I wish you a good day. And thank you for joining the conference today.
It was a pleasure. Thank you.
Thank you.
Cheers, bye.
Bye.
Michelle, listen, that was everybody's gone, everybody's leaving now one by one. You're still with me right now. Just give me your kind of overview very quickly of the last hour or so together within that great discussion. Tell me.
Well, I think that we had a lot of very unique and helpful insights on this panel from a lot of different perspectives. The recurring theme that I'm hearing throughout the different aspects of the topic was really around understanding and aligning goals and objectives with the expectations on the corporate side. So lots of opportunity for corporations to do a better job from their communication strategies internally, but really at the top level of the organization from a leadership perspective, how do business leaders really innovate effectively, both inside and outside their organization? There's a tremendous amount of work that needs to be done there still.
Michelle, listen, it's been great to listen to you, listen to your panelists as well, and look forward. In fact, there was a lot of things, a lot of ideas that were shared in there. So I'm actually looking forward to watching the recording over once again, and I hope you'll do the same as well. So Michelle, thank you so much. We'll leave you now. Again, it's right now here. It is, hold on a second. It's 7:30 in the evening. What time is it there? Remind us all.
It's 10:30 in the morning in Silicon Valley.
Well, listen, Michelle, thank you so much. Enjoy the day, however you're going to enjoy your day over there in the US. We're coming to the end of day one. Thank you so much, and maybe we'll see you again, perhaps in person.
Take care, and thank you so much.
Thank you. Bye-bye. Right, ladies and gentlemen, that's it. We have come we are now at the end of our first day one of Podim 2021. I'm looking across the screen, and my name is not Michel Messina. It was never Michel Messina. Maybe one day it will be Michel Messina. However, as hopefully you'll know, my name is not Michel. It's Peter Hobwood, and yeah, we've had a fantastic day today. And listen, again, if you've enjoyed today, if you enjoyed the content, if you've found it intriguing, you're curious about, again, the content, some of the conversations, the panel discussions, remember all of this, every single minute of today and tomorrow as well, it's all recorded, and you'll be able to watch back and relive all the moments that we've done so beautifully today on day one. If you've enjoyed today, we're going to do it all again tomorrow, and look forward to kicking off tomorrow at, I believe, at 10 o'clock with the Slovenian Startup of the Year competition. Have a good evening, and we'll see you tomorrow.